Welcome to our guide on investing $100. Let's explore the best options together, and welcome back to the channel. Today we're diving into how you can start investing with just $100. We'll explore the best options available, from index funds and ETFs to fractional shares and even real estate. And don't worry, I'm not just going to throw a bunch of fancy terms at you and leave you hanging. We'll break down each option step by step so you know exactly what you're getting into. Let's get into it. Alright, before we jump into specific investment options, we need to talk about something super important: setting financial goals. This is the foundation of any successful investment strategy. Think of it like this: you wouldn't hop in your car and start driving without knowing where you're going, right? You need a clear destination. Investing is the same way. Without a clear goal, you might end up taking unnecessary risks or missing opportunities. You need a destination in mind, a financial roadmap to guide your decisions, so you can make smart decisions along the way. This roadmap will help you stay focused and disciplined. Are you saving up for a down payment on a house? This is a common goal for many people. Maybe you're dreaming of early retirement, enjoying your golden years without financial stress, or a killer travel fund. Imagine exploring new places and cultures without worrying about money. Whatever it is, write it down. Be specific and detail your goals clearly. How much money do you need, and by when? These specifics will help you create a realistic plan. Having a clear target will not only keep you motivated but also help you determine the best investments to reach your goals. It provides a sense of direction. For example, if you're aiming for early retirement, which might be 20, 30, even 40 years away, you have a long-term horizon. You've got time on your side. This allows you to take advantage of compound interest and market growth. You can be a bit more aggressive, taking calculated risks for potentially higher returns. Maybe invest in some growth stocks or even real estate. These options can offer significant growth over time, but if you're saving for a down payment on a house and you're hoping to buy in the next couple of years, your strategy needs to be different. You'll want to play it a bit safer. Short-term goals require more conservative investments. Think about investing in more conservative options like bonds, which are generally less volatile, or even a high-yield savings account. These can provide stability and preserve your capital. Remember, investing involves risk, and there's always a chance you could lose money. It's important to be aware of this and plan accordingly. That's why it's crucial to align your investments with your time horizon and risk tolerance. This alignment helps manage risk effectively. If you're not sure what your risk tolerance is, don't worry. There are plenty of online quizzes and resources that can help you figure it out. These tools can provide valuable insights into your investment preferences and risk appetite. Now let's talk about how to actually invest that $100. It might not seem like a lot, but even a small amount can grow significantly over time if invested wisely. And in my opinion, one of the best ways to start, especially with a smaller amount, is with index funds. These funds offer a simple and effective way to get your feet wet in the world of investing. So what exactly is an index fund? Simply put, it's a type of mutual fund or ETF that tracks a specific market index, like the S&P 500. This means your investment mirrors the performance of the entire market or a segment of it. When you invest in an index fund, you're essentially buying a tiny piece of all those companies. This gives you exposure to a broad range of industries and sectors. Now here's why index funds are so great, especially for beginners. They offer a hassle-free way to start investing without needing to pick individual stocks. First off, they're incredibly diversified. This means your investment is spread across many different companies, reducing the risk of losing money. Instead of putting all your eggs in one basket by investing in just one or two individual stocks, you're spreading your money across hundreds, even thousands of companies. This strategy helps to mitigate risk. This diversification helps to reduce your risk because even if one company or sector isn't doing well, the others can help to balance things out. It's a way to smooth out the ups and downs of the market. Second, index funds are known for their low fees. Lower fees mean more of your money stays invested and working for you. Since they're passively managed, they have much lower expense ratios compared to actively managed funds. This is because they simply track an index rather than trying to beat it. And trust me, those fees can really eat into your returns over time. By keeping costs low, index funds help you maximize your investment growth. Just choose an index fund that aligns with your goals and risk tolerance, and you're good to go. It's a straightforward, effective way to start your investing journey with just $100. Now let's talk about individual stocks. This is what a lot of people think about when they imagine investing, picking individual companies they believe in and buying shares of their stock. It's a classic image, isn't it? The idea of owning a piece of a company you admire or use daily can be quite appealing. And while it can be exciting to own a piece of your favorite companies, investing in individual stocks comes with its own set of considerations, especially when you're working with a smaller amount like $100. You have to be strategic and mindful of where every dollar goes. The main advantage of individual stocks is the potential for high returns. This is the dream scenario for many investors. If you pick the right company and its stock price skyrockets, you could see significant gains. Imagine the thrill of watching your investment grow exponentially. Just look at companies like Tesla or Apple. Their stock prices have soared in recent years, making some investors a lot of money. These success stories are often highlighted in the media, fueling the desire to invest in individual stocks. However, and this is a big however, individual stocks also come with higher risks. The stock market can be unpredictable, and even the most promising companies can face downturns. Remember, investing in a single company means tying your money to the success or failure of that one business. This can be a risky move, especially if you're not well versed in market trends and company performance. If the company faces challenges like increased competition, changing consumer preferences, or even a global pandemic, its stock price could plummet and you could lose a significant portion of your investment. These are factors often beyond your control. Another factor to consider is diversification. Diversification is a strategy that can help mitigate risks by spreading your investments across various assets. With $100, you'll likely only be able to buy a handful of shares in a few different companies. This limited diversification increases your risk because if one of those companies performs poorly, it will have a bigger impact on your overall portfolio. This limited diversification increases your risk because if one of those companies performs poorly, it will have a bigger impact on your overall portfolio. It's like putting all your eggs in one basket. Now, I'm not saying you shouldn't invest in individual stocks. There are benefits to this approach if done correctly. In fact, I personally invest in individual companies that I believe in and have researched thoroughly. Doing your homework can make a significant difference, but it's crucial to understand the risks involved and to approach it with a long-term mindset. Patience and research are key. Don't expect to get rich quick by day trading or chasing the latest meme stock. These strategies are often more about luck than skill. If you're set on investing in individual stocks with $100, consider using a fractional share investing app. These apps can be a game changer for small investors. These platforms allow you to buy fractions of a share in companies with high stock prices, making it more accessible for investors with limited capital. This way, you can still diversify your investments even with a smaller amount of money. Now, if all this talk about picking stocks and researching companies feels overwhelming, don't worry, there's another option that might be perfect for you. Robo-advisors. Essentially, robo-advisors are like having a personal financial advisor in your pocket, but without the hefty fees. They use algorithms and technology to create and manage a diversified investment portfolio tailored to your specific goals, risk tolerance, and time horizon. One of the biggest advantages of robo-advisors is their simplicity. You don't need to be a financial expert or spend hours researching different investment options. Most robo-advisors have a simple onboarding process where you answer a few questions about your financial situation and goals, and then the algorithm takes care of the rest. Another major perk is the low cost. Traditional financial advisors often charge a percentage of your assets under management, which can eat into your returns, especially over time. Robo-advisors, on the other hand, typically charge a much lower fee, usually a small percentage of your account balance or a flat monthly fee. This makes them a much more affordable option, especially for beginners with smaller account balances. Now let's say you're really excited about investing in specific companies, but you're working with a limited budget of $100. Some companies have stock prices in the hundreds, even thousands of dollars per share. That's where fractional shares come in. As the name suggests, fractional shares allow you to buy a fraction of a share in a company, making it possible to invest in companies with high stock prices, even with a small amount of money. For example, let's say you're really interested in investing in Amazon, but its stock price is currently around $3,000 per share. With fractional shares, you can buy, say, $100 worth of Amazon stock, which would give you a fraction of a share. This way, you can still participate in Amazon's potential growth without needing to shell out thousands of dollars upfront. Fractional shares have made investing more accessible than ever before, allowing anyone to build a diversified portfolio with exposure to a wide range of companies, regardless of their budget. It's a great way to get started with investing, especially if you're excited about specific companies but don't have a lot of cash to spare. So there you have it. You don't need a ton of money to start investing. Even with just $100, you can begin building a solid financial foundation for your future. Remember to start by setting clear financial goals and understanding your risk tolerance. If you found this video helpful, make sure to give it a thumbs up and subscribe to the channel for more investing tips and tricks. Thanks for watching, and remember, the best time to start investing was yesterday, the second best time is today.